I think the miners have deserved the poor favor that they're held in by investors. If you take us back to the decade 2000 to 2010, where the gold price increased from what, $250 to $1,900, more than a sevenfold increase, the free cash flow per share of the major mining companies declined. It took real management skill to generate lower cash flow at $1,900 than you had enjoyed at $250. And I think the investment community, myself included, looked askance at that performance and said, are these things businesses or are they floating abstractions? And of course, the value proposition among the length and the breadth of the juniors was worse. What this rather dismal point of view disguises is that some individual issues among both the big companies and the small companies added enough legitimacy and sometimes even luster that the markets from time to time did well. It is my hope that, given the fact that the management teams that presided over the value destruction that occurred in the decade 2000 to 2010 have been thanked and excused, and that institutional investors in particular are keeping the rest of the management teams in the sector on a much tighter leash than they did before. It is my hope that we begin to see margins in the business. It's worth noting, however, for investors, that although the gold price has been going up, the costs of producing gold have been going up too. Input costs in the supply chain for gold have been increasing faster than the rate of inflation, led, of course, by theft, which is to say not theft by miners, but rather theft by governments, royalties, taxes, regulations, offsite expenses, but also followed closely by other inputs costs like labor, energy, steel, and cement. So the margin increases that we would hope to have seen in the move of gold from, say, $1,800 an ounce to $2,200 an ounce, while they have occurred, have been somewhat muted as a consequence of the increasing price of inputs and government take.
Yeah, that makes sense. But then you said that you see this trend could be changing from a management perspective. So the company's a bit better managed. I'm guessing they have lower leverage. There's the potential that they could, at least from if you look at the companies, that they're better run. So that should be beneficial for the prices.
I think that's right. I think you'll see less stupid M&A, and I think that you'll see less speculative mine builds in the future. You saw some mines getting built in the 2000 to 2010 timeframe that frankly didn't make any particular sense given the interest costs that existed then, the prospective margin that existed then, and the capital costs associated with building them. You also saw, on a fairly uniform basis, a real blowout in terms of construction costs. Mines that in the bankable feasibility study suggested capital costs of $500 million, coming at $900 million or $1 billion, which is to say 100% cost overruns. My hope, but also my belief, is that the businesses are and will continue to be better run now than they were in the decade 2000 to 2010 in particular.
Sounds like it's a low bar, so you'd hope so.